Hello everyone, welcome to BISP Solutions. So our today's topic is we'll see Accounting Standard Codification 323, 326 and 330. So Accounting Standard Codification 323 and 326, they are investment and credit losses, and Accounting Standard Codification 330 is for inventory. So let's get started with Accounting Standard Codification 323. So it is a section of Financial Accounting Standard Board Committee that governs the equity method of accounting and accounting for the joint ventures under the US GAAP. It provides guidance on when an investor should use the equity method to account for investments in other entities where they have significant influence, that is between 20% and 50% ownership, but not outright control, and details the associated accounting and disclosure requirements. So what a equity method means? So it means the significant influence. It talks about the significant influence, that is this standard, Accounting Standard Codification 323, it is applied when an investor has the ability to influence the operating and financial policies of the investees but cannot control it. So that is called as a significant influence. So you will hear this word from me, that is significant influence, when I talk about the equity method. So equity method of accounting will be only applied when you have a significant influence over the other entity. That means investor has significant influence over the entity. Now how we'll do the accounting for this investments? So under this equity method, the investor's investment is initially it is recorded at cost, then subsequent adjustments they are made based on the investor's share of the investee's earning or losses, and the investment balance is adjusted for dividend received. Here in this standard we will also see the joint ventures. So this standards also provide guidance for accounting in joint venture arrangements, which typically involve shared control and management among ventures. There are some key aspects of Accounting Standard Codification 323. First it is ownership threshold. So a common threshold for significant influence, and thus applying the equity method, is it owns between 20% and 50% of another company's voting stock. Then we talk about disclosures here in this standard. So this standard requires the investor to make detailed disclosure in their notes to their financial statement, or you can say notes to their accounts, about these equity method investments, including the investee's name of the ownership percentage. Then here we'll also see the changes in the influence. That means if an investor loses significant influence, the accounting for the investment changes, and it is typically accounted for as a standard financial instrument. Here we'll also see about the joint venture accounting. This standard also talks about the joint venture accounting. This standard also addresses the complexity of the accounting for joint ventures, which are formed by entities so that they can carry out a specific business activity, sharing risk and rewards. Here we'll see two contents in this equity method, that is Accounting Standard Codification 323. First we'll see what's equity method, second we'll see equity method accounting. So if you talk about equity method, here if you have 0%, I'm here writing out the ownership percentages. So if there is equity method of accounting will be applied till from 0 till here, that means it should be more than 20 but less than 50%, then we will have to have equity method of accounting. Okay, so and there only the significant influence will be applied. And here if it is having more than 50% of ownership until 100%, that means a consolidation will happen. And below 50%, above 20%, there will be equity method of accounting. and 0 to 20% will be a fair value method. And if it is more than 50% till 100%, then it is necessary to consolidate with the subsidiary entity. Now here we talk about significant influence, and it should have a representation of the board of directors. Significant influence means in equity method it should only be applied when it's a prescribed percentage. If it holds more than 20% but less than 50%. Secondly, it should have a significant influence. Thirdly, it should have a representation on board of directors. Then how we'll do the equity method accounting in this standard? An investment enables the investor to significantly influence the operating or the financial decision of the investee. Now, significant influence means I can take the financial decisions of the company. Who is saying I can take, that means investor can take the financial decisions over the investee. So equity method, in that case, equity method of accounting will be applied. Equity method is not appropriate in the following cases. First case, it should, if it is having a bankruptcy of the subsidiary. So in that case, equity method of accounting will not be applied. First, if it's a bankruptcy is there of the subsidiary company. Second, standstill agreement is signed. If agreement is signed. Third, another small group has majority ownership. Small group has majority ownership. Fourth, a lawsuit or a complaint is filed. Fifth, temporary investment, if it has a temporary investment in the subsidiary. It's not a permanent nature. It is just for the sake of temporary investment has been done. Temporary investment in subsidiary. So if these are the conditions, then equity method is not appropriate in these cases. Now, if you talk about from the accounting point of view, equity method of accounting. So to record the initial investment, the entry path should be investment in investee account debit to cash account credit to common stock account credit to additional paid in capital. Account credit. So this is investment we are booking, and our cash is going, common stock is reducing, cash is reducing, and additional paid cash is reducing, and we are adding up, means this share capital is increasing and the increasing in the paid up capital. Now to record the income, if any income is earned by the investee, in that case you book the entry as investment in investee account debit to share in investee income account credit. This should be your entry to record the income. First was to record the investment, initial investment. Okay, now the third entry that we'll be doing is to record if any dividend is declared by the investee. In that case, if any dividend is declared, then in that case it should have cash account debit, cash account debit to investment in investee account credit. Okay, so this should be the entry. So at last, how will you take out the amount? So you can say whatever is the beginning balance, you will add investors share to it is for the to revalue the investments. You will add the investors share of investees income then you will also subtract any investors share is there of the investees dividend. If you've got the dividend already, some dividend from your investee, you will subtract it. Dividend share, you will subtract that share and then you will reach till the ending balance. Okay. Suppose now on 1st January year 5, West Company acquired a 30% interest in East Company for 2,85,000. So we are saying West has done the investment in East, 30% investment has been done amounting to 2,85,000. Okay. On the acquisition date, that is on 1st Jan, East Company's net assets had a book value of 9,50,000. There was no difference between the purchase price and the book value of the net assets acquired. Okay, so what you will do here, we will say 9,50,000 minus how much. So West Company has acquired 30% investment has done. Net assets was 950 and investment value was 2,85,000. So we'll do the calculation as 9,50,000. We have got minus into 30%. If you do, that will be 285 only. So you can say there is no goodwill, no capital profit or no capital loss. Here it is just how much you have done the investment, this much is the net assets, and 30% of it is like this much is the amount of investment, which is equals to the amount of net asset that you are getting. So it had a net income of 1 lakh and it has paid a dividend of 5,50,000. Okay, so in that case, now you'll do the calculation as what was the investor share, what was the beginning balance at the investor share. If we reduce your dividend share, then you'll get the ending balance. This is how it needs to be done. You will record the dividend declared. You will record the income earned by the investee through these entries which I have already shown you on this. You can see on this Excel sheet, and you have to record the initial investment which is done at the 30%. So you will see here, you will say that investment account investment debit with 2,85,000 because this is only the amount of investment, to cash account credit, that is 2,85,000. Then we'll record the income earned by the investee. So how much is the income earned by the investee? So as I said, had net income of 1 lakh and paid dividend of 50,000. So investment in investee will be 1 lakh into 30%. Okay, so and credit will be share in the investee income. To share in the investee income, this will also be 30,000. Now to record the dividend declared, we will say cash account debit, 50,000 dividend was there. Okay, 50,000 into 30% because it's a share of the profit that we have done. It's a share investment share, so we will say 50,000 into 30%. So this is how you'll do the entries, how you have to record it. Okay, and how you will do the presentation. So investment in the East Company on balance sheet should know 3 lakh, and for the period West Company in the East Company should show 30,000. Okay, now if we talk about the presentation disclosure point of view, financial assets, if they are measured at amortized cost, so if we talk about balance sheet presentation, it will be done on the amortized cost basis. If there is any allowance for credit loss presentation, it will be deducted from the asset, and income statement presentation will be credit loss expense. Okay, so this was about the investment. Here we have seen till now how you know how to record the investment with the help of equity method. Now you can see the credit losses, which we have to see in accounting standard codification 326. So 326, or you can say the current expected credit losses. It's a US accounting standard GAAP that requires company to recognize expected credit losses on the financial assets such as loans over their remaining life at inception, rather than waiting for a probable loss to occur. This forward-looking approach provides a more timely and the transparent view of potential credit losses using historical data and the current and forward-looking information to estimate these losses. Now, what is forward-looking perspective? Unlike the older incurred loss model, this requires estimating credit loss based on expected losses over the entire contractual term of the financial asset. Earlier, we were recognizing the potential losses. They were recognized sooner, leading to increased transparency on balance sheet and providing earlier insights into the financial risk. And if we talk about the collective evaluations of financial asset with similar risk characteristics, they may be evaluated on a collective basis for loss estimation. Now, if we talk about presentation and disclosure, as I said, they are measured at in amortized cost. So, if you talk about balance sheet presentation, they will be presented at the amortized cost. And if you talk about allowance for credit, allowance for credit loss presentation, it will be deducted from assets amortized cost. And then if we talk about income statement presentation, it needs to be shown as credit loss expense. Okay, now jumping on to accounting standard codification 330. Okay, even before moving ahead, in accounting standard codification 326, we have various topics covered like credit losses, comparison of your loss models, what are the presentation disclosures as we just discussed. Now, credit losses means here we have, if we have incurred loss model, so we focus on incurred losses only, and it considers your current economic condition. And if your current expected credit loss model, then it focuses on estimation of estimated losses over the life of the loans, and it also considers current and the management expectation of the future economic conditions as well. It also focuses on sales security, that is the securities which are available for sale, which are measured at amortized cost like leases, current expected credit loss model, and It also focuses on the presentation and disclosure that we just discussed. Now, if we talk about accounting standard codification 330, that is inventory. So this topic provides guidance on accounting and reporting for inventories in the US GAAP. As per the US GAAP, it covers definition, initial measurement at cost, and the subsequent measurement of inventory, including its valuation, classification, and disclosure requirements. It also provides principles for matching inventory cost with the related revenues to determine what are the cost of goods sold and the gross profit. There are some key aspects that we'll be looking into this. First is the definition classification we look at. We'll see how it will be measured at cost. So in inventory, it will be initially measured at cost, which include material, labor, overhead cost, including bringing the goods to their current location and condition. That if it is moved from the factory and bringing to its current location and condition, like if we have purchased some inventories which are in a dismantled condition, so it will include how will you determine the cost of that inventory? It will include whatever material is involved, labor is involved, overhead cost which is involved to that particular inventory, and bringing of that goods to the factory, and then fixing it and bringing it to the usable conditions. These all costs will be included and it will be totaled, and it will tell you as this will become our inventory cost. And if we talk about subsequent measurement, inventory must be subsequently measured at lower of cost or market or the market value, that is your net realizable value, to reflect the potential losses in value due to the obsolescence, damage, or the other market factors. Here under inventory, there are some table of contents. We'll see what's inventory, seller's inventory, what is buyer's inventory, how we do the inventory valuation, inventory system, and inventory accounting. Now, inventory, any goods and materials in which the company has legal title. It should be included in the inventory of the financial statement. Now, there are various types of inventories. First, it is retail inventory. Second, raw material. Third, it is work in progress, and fourth, it is finished goods. So there are various types of all these are the types of inventory that you can do with retail, that is original form of inventory. Raw material means which is held for use in the product. Third, it is work in process, that is it is yet to complete. Finished goods, that means it is ready for sale. So these are the types of inventory. First, it is retail. Second, it is raw material. Third, it will be work in progress. Fourth, it will be finished goods. Now, what is seller's inventory? If we talk about free on board destination, so the title passes to the buyer when the buyer received the goods from the carrier. Non-conforming goods means title when reverts to the seller upon rejection by the buyer on account of wrong goods being shipped. Okay, if there are wrong goods being shipped and the buyer rejected the acceptance, and this will be then title will be given to the seller. And if the title passes to buyer only when the buyer received the goods from the carrier. Now, what's buyer's inventory? For shipping point, FOB shipping point, that is title passes to the buyer when the seller delivers the goods to a common carrier. When seller delivers it, then it becomes a buyer's inventory. Now, if you talk about, there is some, suppose Alpha company's inventory which is held at the year end. The company uses the retail inventory method using the lower or cost or market value. That means cost or market value, whichever is less. So if we consider an example, like suppose this is the item 1. There are 4 items. It tells you cost, then it tells you replacement cost, then it tells you selling price, cost of completion. Okay, so cost, if you consider this, suppose it's a 17, then it is 75, then you have 30, and then 27. Replacement, if you do the replacement, you will get 21, 40, 62, and 18. Selling price, it will be 17, 51, 71, 28. Cost of completion will be 2, 6, 25, and 2. Then here we will calculate the profit. Profit will be here, in first case it will be 5, then in second case it will be 15, then it will be 21, and then 6. So always you have to do the comparison in every case, whichever is the cost and the selling price, whichever is lower. So in this case, so if you see, if you do the replacement cost, this will be the, if you replace this machinery, the cost will be this much. That means you will get 21. So 17 and the difference will of 21, these two will be 5. This is a profit. Then if you talk about cost or the replacement value, whichever is less. Okay, so in that case this will be, now here it will be difference of these two. Then it will tell you 30, see, this is your cost. Now selling price, now you can see the comparison between these two. Always you have to consider whichever is your cost or MRP, whichever is lower, and then it will give you the profitable amount. Okay. Suppose if cost is 17, selling price is 17, then cost of completion is 2. So your profit will be selling price minus your cost of completion, that is your NRV. Okay, and then you will do the calculation between cost or MRP, whichever is less, 17 or 15, whichever is less. Again, if the cost is 30, selling price and the cost of completion, selling price is 71, cost of completion is 25, then NRV will be 46. That means 71 minus 25, that means 71 minus 25, it is 46. Okay, so your NRV is your 46. Here this is your NRV in this case. Here your NRV is 15. Okay. Now in inventory system there are two systems. First is periodic system, second is perpetual system. In periodic system we pass the entry as cash account debit to sales, and purchases account, if you are doing the purchase, then purchase account debit to cash. In perpetual system you book cash as debit, cost of goods sold as debit, then you credit sales and inventory, and then you do inventory account debit to cash if you are selling it. To book it, you say cash account debit, see your cost of goods sold account debit to sales to inventory. Now inventory accounting, if you talk about inventory accounting, it is always considered on first in first out basis, that is FIFO, first in first out. It generally represents actual flow of goods, sell old and unsold newest. Then second method, it is weighted average. This method is suitable for homogeneous products. Then you have last in first out. It does not represent actual flow of goods. That means it will sell the newest and unsold the old goods. That means last in means the newest will be sold first. First in first out, that means old will be sold first. Weighted average, that means you will give the weight to all the inventories which are there. Now suppose if a Gamma corporation has purchased all of its inventory in batches, 1500 units they were sold after purchase and 1500 units after second purchase. In total 3000 units were sold. Okay, so in first batch, if suppose 3000 units were sold, per unit cost is 2.25. Now suppose if you talk about this is a batch, units purchased are 3000, per unit is 2.25. Now if we follow the FIFO method, that means first in first out, units bought were 3000, cost per unit as I said 2.25, so ending inventory will be 6750. Now goods available for sale will be 6750. Okay, in this way you need to do it. In second case, if you consider units bought, in second case it is 2000, then here cost of unit it is 1.75. so ending inventory, if you consider this, it will be 2000 into 1.75, that is 3500. so goods that are available for sale is now 3500. Okay, now third batch is of 5000, cost is 2.5. so 5000 into 2.5 is your 12500. so goods available for sale are 12500. in total you have 6750 plus 3500 plus 12500, that means 22750. ending inventory six seven five zero 3500 12500. Okay, 22750. Okay, in this case this is your ending inventory, this, and cost of goods sold is 6750. that means whatever is the cost of goods sold, that will be 6750. if you total all your cost, so that's your cost. So ending inventory is now 16000. if you change it, now what change will be done? 6750 is the one. if you are first in first out, this is if you follow the first in first out method, that means this was the first when it was purchased. Okay, so now if FIFO method is followed, and suppose any customer orders that you have, they want 10,000 inventory, so first you won't do this, so you will do minus 6750 from here completely. Then how much it is remaining? 10,000 they need, 6750 will be given from the first batch. Now through second batch we will subtract 3250, because everything is purchased on different costs. It's different batches have been calculated. Okay, so if anybody has ordered for 10,000, so first in first out means this has been first come, so we'll subtract it from here completely, and remaining 3250 will be subtracted from this. So now ending inventory will be here 0 in first batch. In second batch you will have 3500 minus 3250, that is 250 you have, and in third batch you have complete inventory. So in total you will be having 12500 plus 250. Okay, now if this is in case of FIFO, that is first in first out. Now in case of LIFO, that is last in first out method, what will happen? If again a customer has ordered for 10,000 inventory, that means the last stock, the latest stock which has been built up, they will clear the inventory from that stock, we'll clear the stock from that batch. So here if 10,000 is being removed, we will be left with 2500. and then here completely we'll have 3500 inventory, will not touch this, and here also we'll have 6750. So at the end we are the total of inventory which will be left with us, that is the ending inventory, will be, the closing stock will be 12750. You see, because obviously this will remain same, we are just changing the methods. The ending inventory obviously will have to remain the same, only the cost pertaining to this inventory is different. Like if we are initially, if we are applying the FIFO method, that means 675, the cost of the inventory that to the other person will be, like here they were saying 6750. So if they are purchasing we have bought at 6750, the cost of the purchase will be this much, then 3250 will be bought from the second case, so into 1.75. that means the cost of the inventory to the buyer will be, to the seller, here you see 30285. This is the actual cost and this much is the amount of inventory. But in case of LIFO method, as we are selling from this particular stock completely, so 10,000 into, it was 2.5. So here you see the cost is 25,000 in case of LIFO. So it depends at what price you are buying the inventory. So this is the way how you calculate the LIFO and FIFO method. Yeah, so in this way we'll calculate and see the what's the closing amount of inventory which is there by applying the different methods. Okay, yeah, so that's all for today. This was only there in accounting standard 330, that is inventory, and we have also discussed 323 and 326, that is investment and credit losses. So that's all for today. Thank you so much for your time. If you have any questions, please contact BISP Solutions. Thank you.